Welcome to the 7th episode of the Next Well Trading Up YouTube Mentorship Program. In this particular episode, we're going to be looking at candlesticks and the psychology behind the formation of candlesticks patterns. This is really going to cause a paradigm shift to your psychology in analyzing the markets. I recommend that you sincerely do not skip any parts of this episode if you really want to comprehend the coming episodes that will cover the foundations of smart money trading methodology and its application to trade setups and executions. So guys, let's look at what really is the candlestick, and then we're going to actually look at the psychology behind candlestick patterns and their formations. So we must understand that candlesticks are actually graphical representation of market price movements within a specified time period. A candlestick may represent price movement that actually occurred in the last 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hours, 1 day, 1 week, or 1 month. When you actually check your charts, that is your MT4 or your MT5, or you check out the trading view, you're going to see there are time frames to each of these trading platforms, where you can see there are the 1 minute time frame, we have the 2 minutes time frame, the 3 minutes time frame, 5 minutes time frame, 1 hour time frame, 4 hour time frame, 8 hour time frame, 2 hours time frame, 3 hour time frame, 1 year time frame, and all these things are in those particular platforms. They are actually present more in the trading view. For your MT4 and your MT5, the one you actually use within your phone, you actually have just the 1 minute, the 5 minutes, the 15 minutes, the 30 minutes, the 1 hour, the 4 hour, the 1 day, the 1 week, and then you have the monthly charts. So what I want you guys to understand is that to all these time frames, each candle formation you see in these different time frames actually represent those specified time period in those time frames. Let's say, for example, you see the formation of a single candle in the 4 hour time frame, meaning it actually took 4 hours for that single candle to actually be formed in the 4 hour time frame. When you see a particular single candle in the 2 hour time frame, it actually took 2 hours to form that single candle. When you see a candle in the 1 minute time frame, it actually took 1 minute for that candle to be formed. When you see a candle in the daily time frame, it actually took 1 day for that candle to be formed, meaning it took 24 hours for that candle to be formed. When you see a candle in the weekly time frame, meaning it took 1 week for that single candle to be formed. So also in the monthly, in the yearly. So the candlesticks actually are graphical representations of market price movements within a specified period. Just the way you can see from the screen is that what a candlestick may represent price movement that occurs in the last 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hour, 1 day, 1 week, or 1 month. So guys, I want you guys to understand the formation behind the candlestick you actually see in your graph, or let me say your charts. So what you can see from the screen is that we have a candlestick, and then you must understand that we have a bullish candlestick and then we have a bearish candlestick. So as we continue, you're going to understand the difference between the bullish candlestick and then the bearish candlestick and the psychology behind their formation. So just the way I've told you guys in the previous episode, we have the bullish market condition, we have the bearish market condition, where the bullish market condition is an uptrend market, a buy market, and then the bearish market condition is actually a bear market, that is a selling market, a downtrend market. So also in connection to the candlestick, when you actually see a bullish candle, it actually means a buy candle. When you actually see a bearish candle, it actually means a sell candle, a downtrend candle. So what you can see from the chart here is we have the candlestick. So the candlestick actually is made up of the candle wick, and then we also have the candle body. So the candle body is actually showing you the volume of the price delivery. So what you can see here from the chart is this is actually the upper shadow or the upper wick of this candlestick. And then what you can see is from this level here to this level is actually the bottom shadow or the bottom wick. So this is actually the real body or the volume of the candle. From this high here to this low, this represents the body of the candle. So this is the wick of the candle. What this basically means is that the market opened and then the market traded to this high points, but then the market returned and then closed at this high points. Because what you can see here, what we have is actually a bullish candlestick. So this is the candlestick. So the candlestick is made up of shadow, or what we call wicks, and then it is also made up of the real body or volume. So the wick also is in two categories. You have the top shadow, or what we call the top wick, and then you have the bottom shadow, or what is called the bottom wick. And then you have the real body or the volume, which is actually between the top shadow and then the bottom shadow. So now we're going to be looking at the bullish candlestick. So the bullish candlestick is actually a buy candlestick, an uptrend candlestick. So when we see uptrend, meaning it is moving to the upside. So what you can see here about this bullish candlestick is that this is the open price level of the bullish candlestick. So since a bullish candlestick is actually an up buy move candle, so it is meaning that the market is going to open at the bottom and then move towards the upside. So what you can see now for the bullish candlestick, this is actually the open price level. So what we can see is that when the market opened, the market gave a movement to the downside to actually create the low. So the market fell to the downside and then the market returned to the open price and then pushed to the upside. And then the market went further to this high point, created the candle high, and then the market returned and closed at this level. So this is now the bullish candlestick formation. Basically, let's look at this diagram. What we are meaning is saying this is the open price. But then when the market opens, the market does not just move to the upside. The market would actually give a sense of a downward movement to actually raise liquidity or to create the low of the day or to create the low price level of that particular candlestick before the market will give the movement to the upside. And then the market will give a movement to create a high. And then the market will return to give us the close of price for that particular time period. So this is now where it's the bullish candlestick. You have the open at the bottom, and then you have the close at the top. So then we have the lowest price that price actually moved to, and then we have the highest point that price traded to before returning to close at this price level. So this is now the bearish candlestick. So for the bearish candlestick, what you can see is that you have the open at the top. So the bearish candlestick is actually a downtrend candlestick, a sell market. When you hear the word a sell, a bear market, means price is falling. So for price to fall, it means price would open at a high and then goes to the bottom. So what you can now see is for the bearish candlestick, we have the open price here. So the market opened at this price level, and then we have the movement of price to the upside. Price created the high, price returned to the open price, and then we have price pushed to the downside and then created a low, and then price returned to give us the close. So let's look at this diagram here to actually explain the candlestick. So what you can see is this is the open price. So price would actually give the movement to the upside to possibly take out liquidity or to just create the high of the day or the high within that time frame. So you would see that the market would give us a push to the upside, and then you can now see that the market will return to the downside to create the low, and then price would come and then close. So this is the bearish candlestick. So you must understand that the bearish candlestick opens at the top and then closes at the bottom. The bullish candlestick opens at the bottom and then closes at the top because it is an uptrend market. The bearish candlestick is actually a downward movement of price to the downside. So meaning the open will be at the high and then we have the fall of price to the downside. So price would create the high, creates the low, and then we have the close of price. So this is the bearish, and then this is also the explanation to the bullish candlestick. So next we're going to be looking at is actually the candlestick patterns. You must understand the psychology behind the formation of these candlestick patterns, because candlestick patterns are the language of the markets. Therefore, if you can understand the language of the markets, if you know how to read these candlestick patterns the right way, you will be able to understand what these patterns tells you about the market dynamics and traders' behavior. So the candlestick patterns are not traded alone. That is one of the very important thing I would want you guys to know. And as we continue with this mentorship program, you get to understand this aspect where I'm stressing that the candlestick patterns are not traded alone. They are traded in confluence with other key technical parameters, which we will look into in this mentorship program. So, and as we go on with the candlestick patterns, I want you guys to understand that you should not focus on the names of these candlestick patterns. You must try to understand the psychology behind their formations, because that is what is most important for you to understand how to define your entry zones in the markets. So let's begin with the bearish engulf candle. So one of the candlestick pattern we actually have is the engulf candlestick pattern. And then we have the bearish engulf, and then we have the bullish engulf. Because we basically have two types of the candlestick. We have the bearish candlestick, and then we have the bullish candlestick. So here is now the bearish engulf candlestick pattern. What you can see is that price is actually moving to the upside. And then what you can see, we have this bullish candle. So what you can see is that the green candle here actually represents the bullish candle, and then the black candle actually represents the bearish candle. You can decide to actually set your candlestick color to any color you actually like. So this is actually the bearish engulf candle. So what we can see is that we have the bullish push of price to the upside. And what you must understand about these candlestick patterns, you want to see them forming at swing points, you want to see them forming at supply levels, you want to see them forming at demand levels, what we call support and resistance level. So for the bearish engulf candle, the formation of the bearish engulfing candle actually happens when the market is in an uptrend, and then the market is trying to create the reversal. So now what we can see is that we have this bullish candle to the upside. Price is facing rejection at a supply level or a resistance level. So meaning price is not being given the opportunity to actually push further to the upside. So the market is trying to create a reversal because the market is reacting at a key level. So what you're going to see in regards to the bearish engulfing candle is, when you see the reaction of price, is you would see that the next candle would actually fail to continue the movement to the upside to close above the bullish candle high points. What you will now see is that the market creates a bearish candle to the downside, and then you would see that the bearish candle is actually going to consume the bullish candle, meaning it is going to cover up the bullish candle. And what you can see is that the volume of the bearish candle closed below the bullish candle low points and also below the bullish candle open price. So what this is telling you is that the buyers can no longer push price to the upside. The sellers have dominated the markets, because you can see that the volume of the bearish market is actually more than the volume of the bullish candlestick. So you can see that the momentum in which the bearish candle made movements to the downside also closed below the low of the bullish candle. So you can see this is trying to tell you that the sellers are now dominating the markets, because they pushed the markets even below the open price of the bullish candlestick. So here's a chart example of that. You can see we are having actually the market moving to the upside. So when price reached a supply level, a resistance level, we can see that the market could no longer push to the upside. Price pushed to the upside, But then when this candle was formed, the market did not push to the upside, where we have a candle body closing above this previous bullish candle. What we can see is just we have price push to the upside. This week actually raided this previous week high point. But then what we can see is that we have price return to the downside. We have sellers pushed price to the downside. And then we can see that this candle has a very massive expansive volume to the downside. Closed below the open price of this bullish candle and also below the low of this bullish candle. So the psychology behind this is trying to tell you that the buyers can no longer push the markets to the upside. The sellers are now dominating the markets, or the sellers have dominated the markets, because you can see this momentum of movement of price to the downside. You can see how massive the movement went to the downside. So now you can see we had the push of price to the upside, meaning the market is actually in an uptrend, but then the price reached a supply level, and then we have the fall of price to the downside. So this is now the bearish engulf candle. You must pay attention to this bearish engulf candle, because this is actually the basis upon which the smart money concept established the order blocks. So we are going to look more into the bearish engulf candle, the bullish engulf candle, when we continue the course of this mentorship program. So the next we have, you can see this example again, is we have price trending to the downside. So you must trade this candlestick patterns in confluence to the market trend, in confluence to the buyers in the markets. So what we can see is that you can see price push to the upside. So let's consider this as the bullish candle, because this created the highest high. Now what you can see is that we have this bearish candle came to the downside and closed below the low of this bullish candle and also below the open price. The same applies to this candle. So you have this bearish candle engulfed this bullish candle, and now you can see price fell to the downside. Now you have price return to retest this level that price broke to the downside. And then what you can see is that we have this bullish candle to the upside. Price now failed to continue the movement to the upside to close above this bullish candle and also this other candle here. And then what you can see is that we have an expansive movement of price to the downside. This bearish candle engulfed this bullish candle and also engulfed this other pin bar candle you're seeing here. When we continue, we're going to look at the pin bar candle, or what we call the Greystone Doji candlestick pattern. So you can see that now this dropped to the downside. What this is trying to tell you is that the sellers are now present in the market than the buyers. It's just the same thing you can see here. When price gave us this bearish candle to the downside, look at the momentum that happened to the downside. So meaning the presence of sellers is actually strong. So this is just a pullback to the upside to further push price to the downside to fill up any form of inefficiency left by this bearish expansive movements to the downside. Now we can see that now price pushed to the upside into this bearish engulf candle, and then you can see price further fell to the downside. So now what we can see again, we have another pullback where price is returning to fill up these expansive movements because price left liquidities. Yeah, price left inefficiency in the markets. So the market is being rebooked by this inefficiency. So you can now see that now price also formed another bearish engulfing candle here. Price could no longer continue upward movements to the upside. We have this bullish candle was formed, but then we have this candle formed to the upside to cut the high. But then the volume of this bearish candle did not close above the close of this bullish candle. Now we have price fell to the downside, closed below the low and the open price. So this is showing us that the sellers are present in the markets. That is why I would tell you guys, do not cram these candlestick patterns. Just try to understand how to interpret candlesticks in the charts. And then you can now see we have the fall of price to the downside. And then price again was rebooked by the engulf candle, where the sell movement started from. price was rebooked to it, and then you see we have the fall of price to the downside. Just the way you can see here, when price gave the bullish move to the upside, which is actually the pullback, we continue, get to understand market structure, how to map out market structure. So now we have the pullback, and then this is where the sell move was initiated. It was rebooked back to where the sell move actually started from. And then you can see price fell to the downside. So this is what you should know about the bearish engulf candle. Let's look at the bullish engulf candle. So this is the bullish engulf candle. The bullish engulf candle is the opposite of the bearish engulf candle. It is when actually a bullish candlestick engulfs a bearish candlestick. Now you can see it here in the chart. We have this movement of price to the downside, and then you must pay attention to finding the bullish engulf candle at swing below points, just the way you would pay attention to finding the bearish engulf candle at swing high points. So now for the bullish engulf candle, we have the bearish candle to the downside, and then what we can see is that a bullish candle was formed here, and then it closed above the high of the bearish candle and above the open price level of the bearish candle. This is trying to tell us that the sellers can no longer push the markets to the downside, meaning price is facing rejection at a demand level, at a support level. And it's why we see the expansive movement of price to the upside, this bullish candlestick, and then price closed above the high of the bearish candlestick and above the open price of the bearish candlestick. So here's a chart example to that. You can see we are having actually a downtrend. And then here we have price gave us this bearish candle to the downside. Now price is facing rejection at a demand zone, at a swing low. Now we can see now that the bullish engulf candle was formed, and then we have an expansive movement of price to the upside. You can see here we actually have this bearish engulf candle to the downside, price return into the bearish engulfing candle and then further fell to the downside. Now here we have price created a bullish engulf candle, giving us a sign of reversal, that the market is no longer going to the downside. The sellers are no longer dominating the market, because you can see that this candle did not move to the downside where the volume, that is the body of this candle, will close below the low and below the close of this bearish candle. Rather, what you can see, we had that movement to the downside, but it is just a wick. Raided this previous candle wick, and then we have the expansive movement to the upside, where price violated the high of this bearish candle, closed even above also the open price of this bearish candle. So this is a sign of reversal. And then you can see we have what? The expansive movement of price to the upside. So this is the bullish engulfing candle and also the explanation to the bearish engulfing candle. So let's look at more chart example to the bullish engulfing candle. So what you can see here, we're having a downtrend market to the downside. Price created the bullish engulfing candle here because you can see that this candle closed above the high of this candlestick. You can see it reclaimed price, and then price again gave us another bullish engulf candle and push further to the upside. So you can see that this candle also rebooked price again and then push to the upside. So now what you can also see, we have another bullish engulfing candle here. We have this bearish candle to the downside. Price here has been failing to push further to the downside to raid this low points here. So we have this bullish engulfing candle was created because what we can see is that this bullish candle closed above the high of this bearish candle. And then you can see how price continued the movement to the upside. The same thing, we have another example of a bullish engulf candle here. Market was giving us a downtrend, but then we have this bullish candle was formed and then closed above the high. And then you can see we have the bullish ride of price to the upside. Price created the bullish engulfing candle here again. Price return, retested, we have the push of price to the upside. So you look out for the bullish engulf candle at swing low points. You look out for the bearish engulfing candle at swing high points. So when we continue, you get to understand swing points. You get to understand pullback, retracement. You get to understand sponsorship zones. So let's look at now the next candlestick pattern you will understand. And I would still tell you guys that what you should understand is not the names, but you should understand the psychology behind their formations. So before we actually move on to actually look at the other types of candlestick patterns and to understand the psychology behind their formation, I want us guys to look at still the bearish engulfing candle and also the bullish engulfing candle. Just the way I've told you guys, I want you guys to pay attention to their formation based on the directional bias you are actually seeing in the markets. It's not all bearish engulfing candle, it's not all bullish engulfing candle that you just trade in the markets. You have to first establish the directional bias. Then you actually utilize this candlestick pattern in confluence with the market trend. So what we can see here, you can see we're actually having uptrend markets in this particular chart example. And then what you can see is that we have this bearish engulfing candle. So the fact that we are actually having an uptrend market renders this bearish engulfing candle not really a strong engulfing candle to pay attention to, because price definitely is going to violate it. And now you can see price pushed to the upside, broke through that particular engulfing candle, which is actually the bearish engulfing candle. Why? Because we are in an uptrend. And then you can also see we also have this bearish engulfing candle that was formed here, but then price broke through it. And then you can see here's where we have the bullish engulfing candle. Price returned to the zone of this particular bullish engulfing candle, and you see price pushed to the upside. Price created a bearish engulf candle here, but then as price returned, price broke through it. Because what? The market is in an uptrend. It is not a downtrend market. So you'll be looking out for bullish engulfing candles in the uptrend. So you can now see here also we have this particular bearish engulf candle. And now what you can see is that now price also traded through this bearish engulf candle. You can see price pushed to the upside. So what you can see is that now the fact that this bearish engulf candle was created, price breached it, it's going to reclaim price to further push price to the upside. Just the way you can see here, it reclaimed price, pushed it. You can see here, reclaimed price, pushed it. The bearish engulf candle, it is actually formed against the trend. The trend here is actually bullish. So what you should be looking out for is bullish engulf candles. Now, the next candlestick pattern we're going to pay attention to is the doji candlestick. This is actually an indecision form of a candlestick, meaning it is trying to show us equal volume of sellers and buyers in the market. Basically, you can see the candle actually opened, market went to the upside, came to the downside, created the low, created the high, but then price returned and then closed here. So we're not really seeing where volume is dictating to us that the market is going to go next. So that is why the doji candle is referred to as an indecision candle. It is showing us equal presence of buyers and sellers in the market. So just the way you can see from this chart example here, we have the doji candle here. Price is pushing to the upside. Price created the doji candle here. So we do not know next if the market is actually going to push to the upside or push to the downside. But basically, the doji candle also a candlestick we look out for at reversal zones. So now, meaning price here is reacting at a resistance zone, at a supply zone, and then the doji candle was formed. Now, what you should actually possibly wait for if you want to establish more conviction or confirmation to actually take the trade setup or to execute your trade is to wait for the next candle to be formed. Now you see the next candle was formed. The volume of this bullish candle did not close above the high of the doji candle. So this is signaling a reversal. And then what you can see next, we have this bearish momentum movement of price to the downside. Now you can see price fell to the downside. Price now is reacting at a demand level. We have the swing low was created. Now you can see we have the doji candlestick here was created. And then now you can see the next thing we have is what? A reversal of price to the upside. So the next candle actually showed us where the market is heading to. Because you can see we have the bullish expansive movement to the upside that closed above the high of the doji candle. And now we can see the market switched into an uptrend market. So the doji candle also happens at swing high points. And then it also shows reversal. But you have to actually wait for the formation of the next candlestick to actually establish more confidence. But then if you're actually sure of the level at which the doji candlestick was created, then you can execute your reversal markets condition that you're actually anticipating. So the next candlestick we have is actually what is now called the dragonfly doji. So the dragonfly doji is actually kind of a bullish candlestick. So this also is formed at what? Swing points. It is also formed within key levels, key zones, support, resistance, supply, demand. So the dragonfly doji, which is also can be referred to as the pin bar. So what you can see is that we have the market trending to the downside. So the dragonfly doji actually leads to a bullish market condition. It leads to a reversal in a condition whereby the market is bearish. So what we can see, we have a bearish market condition here. And then price created the dragonfly doji, the pin bar. So what this is trying to show us is that we are seeing rejection of price. Sellers push price to the downside, but then buyers came and then push the markets to the upside. Meaning the sellers are losing their strength. The buyers are taking charge of the markets. Because you can see that the market actually opened here and then the market pushed to the downside. Sellers pushed the price, but then buyers came in strong and then pushed price back to the upside, and then we have the close here. So this is trying to tell you that the presence of the buyers is now more than the sellers. So you must trade this at key levels. You must identify these patterns at key levels, because you can see we have a dragonfly doji was full here. But this is not within a key level. It is within the trend, but then not within a bullish trend. For you to actually consider this as the possibility to actually continue a bullish move, it is within a bearish market condition. So this would not really be respected because it is not reacting at a key level. So now you can see price fell, created another dragonfly doji here. Price fell. So this was reacting at a demand level. So this made the formation of this candlestick pattern valid. So you must understand the psychology. This is actually reacting at a demand level. Buyers push the price, and then you can see the next candle pushed to the upside and then closed above the high. And then we have the bullish market condition. So we're going to look at the gravestone doji, which is actually now the bearish candle type for this particular doji candle. So you can see here we have the gravestone doji. The buyers pushed the markets to the upside, created the high, but then sellers came in so strong and then pushed the price to the downside. And then we have the close of price to the downside. The market opened, price pushed and created the high, but then sellers came in so heavily and then pushed the price. So this is trying to show us that the buyers have lost their strength, actually keep pushing price to the upside. The sellers have now dominated the markets. So the candle color doesn't matter. You must just understand the psychology. Because now what you can see from the chart example is this is actually giving you a bearish color. But here I used a bullish color. So you must just look at the chart and understand the psychology behind the formation of the candlestick. What you can see is that buyers pushed price to the upside because it is the movement of price to the upside that created this week. But then sellers came and then heavily pushed price to the downside. And then you can see that led to a reversal. So this is what is now identified as the gravestone doji. It is still the same as pin bar. Why? Because price left this week here. So the volume is just so little. So the next candlestick we're going to look at is the tweezer, the evening star, the morning star. But before we actually head to those candle patterns, let's look at more in regards to the gravestone candlestick pattern. So what we can see here is, you can see that price here is in a downtrend. So price gives us this movement to the upside. When you draw your trend line here, you're going to see that price is reacting at the trend line. Price returned to this price level that was broken, was retesting it. The second time, you have the first return that retested. Now you're having this return that is retesting it. Now what you can see is that now price gave you the gravestone candle. The buyers were pushing the market to the upside, but then sellers came in so heavily and pushed it to the downside. So you can see the example of the gravestone doji in a trend, within the trend. So you can see when you see this within trend, it is still trying to tell you that the market will continue for the movement to the downside. So now you can see now this formed at a swing high point. Now you can see price gave the push of price to the downside. Now you can see that a dragonfly was formed here. But the fact that we're in a downtrend would not actually make this dragonfly doji a strong candlestick pattern to consider, because it is against the trend. Now that is why you can see price violated it. Price created another one. Price violated it because it is against the trend, which is actually bearish. The next candlestick now we have is the morning star. So the morning star is actually formed in a bearish market condition that is going to lead to a bullish market condition. So the morning star basically is where you have the bearish candle to the downside, and then price created another candle within the bearish candle. This candle fails to make movement to the downside to close below this bearish candle low, but then price actually just closed within the bearish candle, not even up to the 50% of the candle. And then next you now have a bullish candle to the upside, where the bullish candle closed above the main threshold, the midpoint of the bearish candle, and also engulfs this candle that is within this bearish candle and the bullish candle that was formed. The bullish candle doesn't necessarily have to close above this other bearish candle, but if it closes above the midpoint of the bearish candle, it is signaling that the market is trying to push to the upside, because one, the next candle that was created did not push further to the downside to close below this bearish candle. So the candle in the middle can be of any color, can be bullish, can be bearish. So now what we can see here is that we have price pushed to the downside here. So what you can see is that we have this bearish candle to the downside. This price movement returned into this engulf candle here. And then we have the morning star candle pattern was formed. Because what you can see is we have this candle made a movement to the downside, raided the low, but did not close below the low of this bearish candle. And then we have this bullish movement of price to the upside. And then you can see that this bullish candle closed above this high and above the midpoint of this bearish candle. And then you can see we have the reversal, price pushed to the upside. So next we have the evening star. So the evening star is actually the opposite of the morning star. So basically the morning star meaning the rise of price, the evening star, the fall of price. So what we can see in the evening star is that we have a bullish move of price to the upside. So we're expecting to see a continuation of price to the upside, where the next candle would actually move to the upside and close above the high of the bullish candle to show us that price is going to continue for the bullish movement to the upside. But then now we have a bearish candle was formed that closed below the midpoint of the bullish candle. So this is trying to show us that the sellers are dominating the market, because this candle failed to actually close above the bullish candle, and then the next volume of the candle that was created closed below the midpoint of the bullish candle and also engulfed the candle in the midpoint. So we're having a signal that the market would fall to the downside. So you can see now we have the market falling to the downside. And then now we have that price return to the upside. And now what you can see, we have this bullish candle to the upside. Price created this bearish candle. Price was trying to fall to the downside, but then first price pushed to the upside, swept the high of this bullish candle, and then price returned, but failed to actually close at the midpoint of this candle. The next candle now closed even below the midpoints and also below the low of the candle. So you can see we have what the evening star here. Price return, and then we have the fall of price to the downside. So the next candlestick pattern we have is what we now call the bullish inside bar. Just like a pregnant woman with her baby inside her. So that is the same thing with the inside bar candlestick pattern. We have the inside bar, which is a bullish, and then we have the inside bar, which is bearish. So now this is the bullish condition. The bullish condition of the inside bar is where you actually have market moving to the downside, and then a bullish candle is now created, and then it is now within the bearish candle, not up to the midpoint of the bearish candle. So it is signaling that what the market is trying to reverse, because the next candle did not continue the movement to the downside to close below the low of the previous bearish candle. So you can see in the chart's case here, you can see that we have price giving us this bearish movement of price to the downside, and then you have the inside bar. This candle closed within this bearish candle. Price just moved to the downside, raided the low, but did not close below the low. And then you can see we have reversal of price to the upside. So the next we have is now the bearish inside bar. So the bearish inside bar is actually in a bullish condition where then we're expecting a reversal to be bearish, where we have a bullish candle and then the bearish candle close within the bullish candle. So you can see here the market is going to the upside. We have the bearish inside bar. This is the bearish candle that is within this bullish candle. It failed to continue the movement to the upside to close above the high and the close price of the bullish candle. And then we have the fall of price to the downside. The next we now have is what we call the tweezer bottom, and we also have the tweezer top. So the tweezer bottom, as you can hear the word bottom, is actually formed at swing low. So the tweezer candlestick pattern basically for the tweezer bottom is when we have the markets falling to the downside, possibly a pullback, and then we have a bearish candlestick. And then the next candle is a bullish candle that closed above the open price of the bearish candle. That is now the tweezer bottom. The market did not close above the high. It closed above the open. It means that buyers are pushing the market to the upside. For the markets to actually close above the open of the bearish condition, it means that buyers are more present than the sellers because they've gone beyond the price level where the sellers actually sold from. So it means that what the buyers are dominating the markets. So that is what we can see from the chart example here. We can see that the market fell to the downside, but then we have this bullish candle closed above the open price of this bearish candlestick. So this is signaling to us that the buyers are heavily present than the sellers. And then we can see price gave us this expansive movement to the upside. So for the tweezer top is actually when the market is actually in a form of a pullback to the upside, and then we're expecting an expansive move to the downside, or it is found within a downtrend market condition. So what we can see is that we have the bullish push of price to the upside, and then the bearish candle closes below the open price of the bullish candle, not necessarily the low of the bullish candle. So that is now the tweezer top. So you identify it at swing high points. For the tweezer bottom, we identify it as swing low points. So now you can see we have that here, price push to the upside, and then we have this bearish candle to the downside that closed below the open price, not necessarily below the low. but the engulfing candle, it closes below the low. For the tweezer, it closes just below the open price or above the open price, depending on the type of tweezer candle we are referring to, either bullish or bearish. And then now we can see price give us the expansive movements to the downside. So this is all you have to know about candlestick patterns. I would still say this, guys, that you do not need to cram the names. What you need to understand is the psychology behind their formation. Cheers, guys, till I see you in the next episode.